Everyone keeps asking if the commercial real estate market has bottomed out. We think that's the wrong question.
Hey everyone, Logan Freeman here. It's February 2026, and I want to give you a straight shooting update on where we are in the commercial real estate cycle. What's happened over the last year, what surprised me, where the opportunities are, and most importantly, what you need to watch for the next 12 to 24 months. If you've been following along, you know that I'm a proponent of understanding the 18-point CRE real estate cycle as my framework. And last year I said that we were entering into this winner's curse, right? The mania phase, that dangerous final stage where everyone's bullish, prices are peaking and leverage is maxed out. I warned about a $1.5 trillion debt maturity wave and said that we are heading into a contraction. So where are we at today? Have we entered the full contraction? Are we recovering? Are we in something in between? And I think the short answer is that we are in a transitional phase between the winner's curse and the early contraction, but with a major twist. We're seeing a rolling recession by sector and not a broad-based crash. So let me break down what that means. But first, I want to give you a quick refresher on the 18.6-year real estate cycle. This isn't some theory that I made up. It's a repeating pattern in land and property values documented for over 200 years by economists like Fred Anderson. But first, let me give you a quick refresher on the 18.6-year real estate cycle. This isn't some theory that I made up. It's a repeating pattern in land and property values documented for over 200 years by economists like Fred Harrison and Phil Anderson. The cycle has 4 phases, okay? Recovery is years 1 through 4. So we're coming out of a recession. Prices stabilize, transactions pick up slowly, sentiment is cautious. So think 2009 to 2012. Expansion is years 5 through 10. This is where confidence returns, lending loosens, and prices rise steadily. Everyone believing that this time is different. Think 2013 to 2018. Then the winner's curse, right? Years 11 through 14. This is that euphoric phase. Prices at all-time highs, leverage maxed out, marginal buyers flood in, cap rates compressed to historic lows. Think 2019 to 2023. And then we hit the recession years, right? Years 15 through 18. The music stops, interest rates rise, over-leveraged assets default, transaction volume collapses, and prices correct. This clears out the excesses and sets up the next cycle. We last saw this in 2008 to 2011. Why does this matter? Because real estate isn't random. It follows predictable patterns driven by credit cycles, land speculation, and human psychology. And if you understand where you are in the cycle, you can work on buying low in the recovery and avoid being the greater fool who buys at the top. So it's early 2026. Where are we? Here's what has happened that confirms the cycle. Transaction volumes have crashed. We went from $780 billion in 2022 down to $450 billion in 2023. That's a 42% collapse. That's classic early contraction. But the market froze because buyers and sellers were 20 to 25% apart on pricing, and debt was suddenly expensive. We saw a 20% valuation correction. Office dropped 35% from the peak values. Self-storage dropped 21%, and apartments were down 19%. That's real pain. And the debt maturity wave is here. $1.5 trillion in commercial real estate loans maturing from 2024 to 2027. Borrowers who locked in 3% rates in 2020 are now facing 6 to 7% refinance rates or getting denied entirely. And that's forcing distressed sales. So again, we talk about discretionary sellers and non-discretionary sellers. But here's the twist. 2025 was also a recovery year. Transaction volumes rebounded 17% year over year. We're now at $550 billion annually for 2025, up from $450 billion, and loan originations are up 47%. Property prices have also stabilized and even ticked up slightly. So what's going on? Are we contracting or are we recovering? Well, here's my read. We're in a rolling recession by sector, not a broad-based crash. Office is in full contraction. We're down 35% from peak. We got distressed debt everywhere, very little institutional capital playing in that space. Sunbelt multifamily is oversupplied. Markets like Phoenix and Austin, Nashville are overbuilt and are bleeding rent growth. But necessity-based sectors are thriving. Data centers grabbed 37% of all capital raised in 2025. Industrial transaction growth is up 26.5%. Grocery anchored retail is seeing double-digit growth. Medical office vacancy is at 7 to 9% versus 14% for conventional office. So again, instead of the entire commercial real estate market going into recession, we're seeing bifurcation. Top quartile assets in defensive sectors are acting like late expansion. Commodity assets and over-leveraged deals are acting like early contraction. So if I had to label it, we're in the pause before the final leg down. But that final leg might be sector specific, not economy wide. So three big things changed over the last year. Two confirmed my thesis and one surprised me. The first one that confirmed me was the debt maturity wave that is real. 2025 saw $957 billion in maturities. That was the peak year. 2026, we will see around $875 billion. But here's the kicker. $167 billion of that is office debt in 2026, plus another $123 billion in 2027. Borrowers who locked in 3.5% rates are now being quoted 6.5% to 7.5%. For a $50 million loan, that's an extra $2 to $2.5 million in annual debt service. A lot of owners can't cover that. So they're either injecting equity, selling at a loss, or handing the keys back to the lender. The good news is that new loan originations are up 27% in 2026. So lenders are lending again, but they're ultra selective. If you've got a Class A industrial deal with 95% occupancy, you're getting financed. Class C office in San Francisco with 40% vacancy, you're not. This is exactly what the cycle predicts. Credit tightens, marginal borrowers get flushed out, and only the best assets survive. Number two that was confirmed. Sector divergence is extreme. I said last year that we're seeing a barbell market, winners and losers, no middle. And that's playing out in spades. Data centers are the mega story, 37% of all commercial real estate capital raised in 2025. Blue Owl closed a $7 billion data center fund. Why? Well, AI and cloud computing demand is structural, not cyclical. Every company needs more computing power, and data centers are the new infrastructure play. Industrial is still strong. Transaction volumes are up 26.5% year over year. Last mile logistics near metros are hot. Grocery anchored retail has double-digit transaction growth. Necessity-based demand. People need to eat, right? There's 3+ anchor leases with investment grade tenants like Kroger and Walmart. That equals stable cash flow. Medical office is gaining traction, 79% vacancy versus 14% for conventional office. Baby boomers are aging. Healthcare demand is secular. Meanwhile, offices in free fall. We're down 35% from peak, but there is a flight to quality. Class A trophy office in gateway cities are seeing plus 28% year over year transaction growth. Big employers are consolidating into fewer, better building. So Class A is stabilizing. Class B and C is still struggling. Multifamily oversupply in the Sunbelt. So Phoenix, Austin, Nashville, Tampa, overbuilt, right? So deliveries are 2 to 3 times historical averages. Rent growth is negative and concessions are spiking. What does this mean? It says stop investing in commercial real estate as a broad category. You need to be sector specific and subsector specific. Data centers and grocery retail are acting like mid-expansion, while Sunbelt multifamily and commodity office are acting like mid-contraction. And here's what surprised me is this Goldilocks moment. This caught me off guard. In early 2026, in January, the 10-year Treasury dropped from 4.3 to 4.13% in just a few days. Weak retail sales data spooked the bond market. And I wrote a piece titled, "Has Goldilocks Left the Building?" because this could be an inflection point. If the 10-year Treasury drops to 3.75% and stays there for 6+ months, that's game-changing for commercial real estate. Lower borrowing costs is going to unlock deals that have been on hold since 2022. I expected the Fed to hold rates a little bit higher, a little bit longer, but if economic data continues weakening, the Fed might cut faster than expected. And that could trigger a mini boom in transaction volume in the second half of 2026. However, I'm not ready to call this a trend yet. We've seen false starts before. I need 3 to 6 months of sustained lower yields before I can change my positioning there. Here's what concerns me most. A recent survey showed 75% of passive real estate investors plan to increase their investments in 2026. That's a contrarian red flag. Here's the investment principle that I try to follow. Buy when everyone's fearful and sell when everyone's greedy. If 75% are planning to increase investments, that tells me that we're still in the greed phase, not the fear phase. But let me be clear about multifamily specifically. That's the sector that most passive investors are in. There's bullish narratives that people are still saying, right? Multifamily always bounces back. There's a housing shortage. Fundamentals are strong. Interest rates are coming down, right? So values are going to recover. My sponsor has a great track record. And here's some of the bearish narratives that I'm hearing from informed operators, right? Sunbelt multifamily is oversupplied. We have 2 to 3 times the normal deliveries. Rent growth is negative. It's down 2 to 5% year over year. Lots of concessions are spiking. 2 months rent free. No deposit. Refinance risk is real. Sponsors who bought in 21 and 22 at 3.5% rates now face 6.5 to 7% refi rates. So some sponsors are handing the keys back rather than injecting more equity. But am I hearing people say that they dislike multifamily yet? Not yet, but we are getting somewhat close. When I hear passive investors saying, I got burned, never again, when sponsors say we're liquidating and sitting on cash, when institutions say we're underweight multifamily for 3 to 5 years, that's when I know we're at peak fear, and that's the time to buy. But right now, I'm hearing my deal's down 30%, but I'm holding because it'll come back, right? That's hope, not fear. I'm being more selective, but still investing. That's caution, not fear. My sponsor says this is a great buying opportunity. That's bullishness disguised as opportunism, right? But there's not capitulation. That's dip buying mentality, which is what you see in the late winter's curse or early contraction, right? The fact that 75% are increasing allocations tells me we're not at peak fear yet. We're in the cautiously optimistic phase. So what am I seeing a lot of investors actually be successful on right now, right? Even though I'm cautious on multifamily, they're not sitting on cash. And here's where they're being active is grocery anchored retail in the Midwest, right? Necessity-based demand. People need to eat, right? Small bay industrial under 50,000 square feet. Last mile logistics near major metro hubs, right? Think Kansas City and Columbus and Indianapolis. 12 to 15,000 square foot buildings are the sweet spot. Owner users can buy with SBA 504 financing, and they get good financing rates. Medical office near hospital clusters, right? As baby boomer demographics equals secular healthcare demand, right? And Midwest markets are cheaper than gateway cities, right? There's a lot of people getting into triple net lease, single tenant net lease deals with investment grade credit, right? Data centers if you can access them. But things that I've seen people avoid are Sunbelt multifamily, Class B and C office, over-leveraged value-add deals, and any deal with a 2025 to 2027 loan maturity rate, right? So I think that, the strategy for 2026 is be in those defensive sectors, right? Small bay industrial, grocery retail, medical office, 30% dry powder for opportunistic distress buy in late 2026, early 2027. Now let's talk about the Fed and how debt maturities are interacting. So what's happened with the Fed? They held rates at 5.25 to 5.5% through most of 2024. Then they cut 2 to 3 times, totaling 75 to 100 basis points. As February 2026, the Fed funds rate is around 4.5 to 4.75%, and the 10-year Treasury is around 4.1 to 4.3. So what does that mean for commercial real estate? Well, the Fed rates, the cuts helped, but not as much as people had hoped. Treasury yields dropped about 40 basis points. CMBS spreads tightened from 300 basis points in 2023 to about 200 basis points now. That's bigger than the Fed rate cuts, means lenders are more willing to lend. But all-in borrowing costs are still 6 to 7% versus 3 to 4% in 2020 to 2021. That's a massive jump for borrowers who bought at peak prices, right? And the debt maturity timeline looks like this. 2025 is got $957 billion in maturities. That was our peak year. 2026 is down 9% to $875 billion, right? So what's happening in actual practice? Scenario one is that you can refinance. That's the best case, right? Your property is stabilized, 90+% occupancy, strong NOI, good location. Scenario two is you can't refinance, so you got to sell, right? Scenario three is you hand the keys back. And how these forces are interacting, the Fed's rate cuts are helping scenario one, borrowers, from lowering costs from 7.5 to 6.5%. That's meaningful. But rate cuts are not necessarily helping scenario 2 or 3 because the problem isn't just interest rates, it's underlying fundamentals, right? So again, we're in a bifurcated market. Top quartile assets are seeing a soft landing. Bottom quartile assets are seeing a hard landing. Here's my one prediction for 2027 that I want to be held accountable for. By Q4 of 2027, we're going to see a bifurcated market where winners are the top 25% of assets. They're fully recovered to 2022 peak pricing or exceeded it. Data centers, grocery anchored retail, small bay industrial, medical office, Class A multifamily, and stable Midwest markets are going to trade at or above 2022 cap rates. Transaction volumes in these sectors probably up 20 to 30% versus 2025. Again, the losers are going to be that bottom 25% of assets, right? They're going to experience another 20 to 30% decline from today. So that's commodity office, over-leveraged Sunbelt multifamily, low-quality retail is going to be in distress. Cumulative, I think, distress is going to be somewhere between 150 to $300 billion. Right? The middle 50% is going to be stuck in no man's land. It's not recovering. It's not crashing. It's just grinding sideways. This isn't a prediction that the entire market crashes or booms. I think that's lazy thinking, but this is a prediction that the cycle framework is still valid, still playing out differently by sector, not uniformly. Data centers are acting like year 8 of the cycle, mid expansion. Grocery retail and small bay industrial are acting like year 10, late expansion. Office and over-leveraged Sunbelt multifamily are acting like year 16, mid-contraction. But by Q4 2027, I think this bifurcation will be complete. Winners fully recovered, losers experiencing another leg down. Here's how to measure this. Check Digital Realty and Equinix stock prices. If up 30 to 50% from February of 2026, I was right. Check office vacancy. If at 16 to 18% nationally versus 14% today, I was right. Check cumulative distressed sales. If it's exceeding $300 billion, I was right. Check the multifamily rent growth in the Sunbelt. If still negative or flat, I was right. And why I'm confident on this is that the debt maturity wave is non-negotiable, right? $1.5 trillion in loans maturing. Borrowers who can't refinance will sell, right? Sector fundamentals are diverging. Data centers, grocery retail, small bay industrial have structural tailwinds. Office and Sunbelt multifamily have structural headwinds, and capital flows follow performance. There's $250 billion in dry powder, and that's going to flow to winners and avoid the losers. Once capital flows in, prices recover, and once capital flees, prices crash. So here's the bottom line for February of 2026. We're in a transitional phase between winter's curse and early contraction, but it's a rolling recession by sector, not a broad crash. Office and over-leveraged multifamily are in contraction. Data centers, grocery-anchored retail, small bay industrial, medical office in late expansion. The debt maturity wave is the forcing mechanism for the next 12 to 24 months. $875 billion maturing in 2026. That's going to flush out weak borrowers and create distressed buying opportunities. The Fed's rate cuts are helping at the margin, but they're not a help get out of jail free card. Borrowing costs are still 2 to 3 times higher than they were in 2020, 2021. Investor sentiment is still very bullish. 75% of passive LPs are increasing allocations. That's not peak fear. That's the dip buying mentality, right? So my prediction is a bifurcated market. Winners fully recover. Losers drop another 20 to 30%, and the middle grinds sideways, right? So stop thinking about commercial real estate as one asset class. Be sector specific. Data centers, grocery retail, small bay industrial are not the same as Sunbelt multifamily and commodity office, right? Be patient. The best deals will come in late 2026 and 2027 when distressed sellers are forced to sell. Don't rush in because everybody else is. And remember, when everyone's fearful, sell when everyone's greedy. And remember, buy when everyone's fearful, sell when everyone's greedy. That's it for this market update. Stay sharp, stay selective, and stay patient. I'm Logan Freeman with Midwest Commercial Real Estate Advisors. If you're interested in chatting with me about this in more detail or looking at buying or selling commercial real estate in the Kansas City metropolitan statistical area, please reach out.